Yesterday, under the theme Viksit Bharat Envisioning India at 2047, we painted a picture of the future, an India that is bold, self reliant, and globally admired. We spoke of ideas and opportunities that can outlast decades and even centuries. Today, we bring the focus to the present moment, to the opportunities and choices that will define how we reach to that vision. Our theme, India at Amrit Kal, investing in India's next leap, is about action. It's about how conviction, when backed by capital, can unleash the true potential of this Amrit Kal. Over the course of the day, you will hear from entrepreneurs who are shaping new industries, from investors who are identifying tomorrow's leaders today. Together, these conversations will show us how the building blocks of Viksit Bharat are being laid right now. So, let us begin with our first session of the day, that is on small case to growth case sees the passive investment shift. May I now welcome Ms. Gunchan Kabra from Niveshaay to introduce us to the session.
Hi everyone, very good morning and thank you so much for coming and welcome to the Thando Valley again. So this panel is very close to us because it's Smallcase and we were the early users on the platform of Smallcase. We started our business on Smallcase in 2019 and built and was very surprised and astonished that how this scalable platform has built up our brand visibility as well. So in 2019, when we started and we got to know about this tech platform that, Vasant and the entire team of Smallcase has built up, we thought let's just give it a try and we uploaded our model portfolio of mid and the small cap, the flagship portfolio. And going forward, we thought that, wow, such a platform to, tap the underpenetrated equity markets in India. And then going forward, when we thought that green energy as a theme is expected to do pretty well, and we were finding ways to play in India, we were not able to find any instruments to play in. And then came this platform which enabled and the entire country to, tap on this opportunity with the green energy small case. And you can build up all the thematic portfolios on the platform, right? And it's a very robust platform in terms of usage and experience. We thought, let's give it a try and let's just play out this theme. And it turned out to be a really massive success in playing out this theme when literally there was no instrument to play this theme in India especially. So that's how then we thought that let's curate this portfolio and come up with many more themes. And that's how we launched, consumption as a theme. And now the wave of IPO, how to play it. So a very good platform. That's what we, understood and realized and experienced. And having worked with them for so many years now, can really vouch for their execution, that how the division of responsibilities have happened at Smallcase amongst the three founders and the team is very reciprocative. So when you like the product, you experience it, and then you think that, how to invest in that product now. So after chasing him for a lot of time, we thought that now then came up this investment opportunity, and we were up and all ready for it because we have experienced the usage that has helped our building up of brand as well. So we could reach a lot of people, which we would not have otherwise reached, the people of our country, especially and worldwide as well. So then came up with this the Zerodha Fund House, the AMC business, how they want to tap the passive equity investment, one of the leading fund houses in the passive equity investment. And how this network effect in this business model can come in. So when we got this opportunity to invest through our fund, both the funds we invested, we really immediately grabbed on and want to see how this, the AMC business and the publisher business of Smallcase can, scale and reach great heights because it's a market where, consumption as a team, wealth management is the most important part of it, right? So because there are like humongous favorable factors in terms of the ecosystem that that our country is building up, which we are discussing since last 2 days now, and we'll be discussing the entire day today, and plus the consumption boost that we are getting. So lot of investments will happen in our country that ways. It's what we expect. So wealth management is another very interesting theme. So yeah, so welcome Vasant. Uh, So he'll be presenting today and explaining the business model of the small case. So excited to listen to you.
Hi everyone, good morning. I know we're already running late. Gunjan has already told me to finish the session in, I think, 5 minutes, but I think I'd take a little longer than that. But it's so humbling to be here with all of you. I think Arvind Bhai's, Gunjan, Vikram's journey at Niveshaay started around the same time that we started Smallcase. This was in 2015 that we started the company, 2016 that we launched the business, and to basically see Niveshaay and the entire family grow from one of our partners to then eventually setting up their own fund and now coming onto our cap table along with the entire family. It's just very, very humbling for us, and I'm very lucky to be part of this family with all of you. And both yesterday and today have just been uh, so joyous in terms of being able to share that with the entire Niveshaay family. So thank you so much for that, and thank you for this opportunity to invite me here. Uh, just this is the first time that we are also introducing our new brand in the sense we've changed our company's name from Small Case to Case Platforms. You'll get an understanding of why we have done that, but I think the idea was to move from what we were traditionally known for or what we started 9 years back, given that we are doing many more things today. And that's a little bit of what I'll introduce all of you to. After that, we'll talk about what we are seeing in the industry that we think will play out in the next, over the next decade. And happy to answer any questions either during this session or after that as well. But yeah, so we are Case Platforms. It's been a journey for us as well. It's like on day one, we don't fit into the typical archetype of what you would consider wealth management companies. You're a broker, you're a wealth manager, you're a asset manager, fund manager, etc. We started out trying to solve problems. That's what we continue doing today. But I think it's become a little easier to explain what we do. So we'll start out with that. We launched, like I said, in 2016. We have a team of 330 people. We are based out of Bangalore. 80% of our team are actually product and engineering. So we're a technology first venture in the asset and wealth management space. And we've been really fortunate and blessed to have a wonderful set of shareholders with us in our latest capital raise, obviously Niveshaay AIFs, State Street, which is one of the largest asset managers globally. They were the inventors of the ETF. They launched the first ETF globally. We have institutions like HDFC Bank, Amazon with us. We have respected individuals who operate in this space, right from Hemendra Bhai from DSP to Utpal Bhai from Trust Group to Nitin from Zerodha. All of them are also shareholders, but all of them believe in the vision that we're trying to solve. But today, if you look at the business, we do two things. Kind of what we were 5 years back was a mixture of these two, but I think it's becoming a little more clearer how we can distinguish our business. We are a provider of investment products. Today, we cater to the individual investor, mostly the retail investor, but we provide investment products to them. And we also build technology platforms for the wealth management industry. Within investment products, we kind of now have two different formats in which we do this. We started out with model portfolios, and today we also offer index funds and ETFs. I'll go deeper into them in a bit, but these are the two kind of investment products that we're offering today, but we want to continue building along these lines of offering the relevant, honest, straightforward investment products that every individual should have in their portfolio. With model portfolios, this is what many of you know. Yesterday, as I met a lot of you, I realized all of you have touched or used Smallcase in many ways, but that's what we started 9 years back, the Smallcases platform, where a small case is nothing but a basket of either stocks, ETFs, REITs, InvITs. Just last month we launched mutual fund, so you have portfolios or baskets of mutual funds that you can invest into. And early next year, we'll also launch global equities so that you can basically have a larger part of your portfolio being invested through model portfolios or small cases. As a concept, model portfolios aren't new in India, as in it's always existed, mostly on the institutional side, like you have a CLSA, Jefferies, etc., offering model portfolios of their own research. But on the retail side, I think uh, it's kind of been pioneered by us over the last 9 years. So much to the extent that now we have a term for it, which is defined by the regulator. Only this year is when the term model portfolio came in, what a model portfolio is, who can create it, which licenses are allowed to create it, how you can present a model portfolio, all of that only became clear this year. So very, again, humbling to basically be part of a journey where we could make this concept mainstream, and then now, there's validation in terms of how the regulator also looks at it as an important aspect or an important part of investors' portfolios. Uh, we started the publisher platform. That's one of our platforms to help independent investment managers, be it research analysts, advisors, to basically create these model portfolios. Early on, we had to kind of build out the concept. I think we'll talk about that later in the day from a marketplace perspective. But today we host 140 plus investment managers on our platform. These are all specialists, strategists for either stocks, ETFs, REITs in their own right. They have their own individual outlook, their own expertise in different strategies or sectors or themes or objectives, which basically comes out as a product that you can add to your portfolio. Of these 140, obviously, many of them are in the room. Niveshaay was one of our first ones to also go live. But across all the model portfolios on our platform, over 1.5 lakh crores has been transacted over the last 9 years. Obviously, I think, for example, the last year has seen maybe 60,000 out of this 1.5 lakh crores being transacted. So today it's become a core part of investors' portfolios. Very kind of proud to say that now how people look at small cases is not just a new product or a novel way of investing, but across our base of investors, on an average, 1/4 of their equity portfolio sits inside model portfolios of small cases. So along with the entire collective of managers and the industry, very proud to have made this into a fast growing, fast expanding product class. Yeah. Moving on to the next thing, this is more of a recent journey. This is where we decided, or this is more around 2020, where we applied for an asset management license. We saw that, like model portfolios, another new asset class or a product class will emerge on the passive side, where there's an opportunity to create a distinct brand for index funds and ETFs in India. That's where we got together with Zerodha, started our own joint venture, applied for an asset management license. We got the license just less than 2 years back in September 2023. Launched our first fund in November 2023. Next year we'll turn 2 as a business. But I think today we have 12 funds live. All of them are either index-based or ETFs. That's a call that we've taken. We were the first ones to be a passive-only or index-only fund house. We are the only ones today to be index-only and also be only direct-to-consumer, in the sense that we are the only fund house today to only have direct plans. So we built this very differently. And it's the first 2 years, I think first 2-3 years is about building your first set of products. So we're still in that journey. I think we have another 6-7 products before we can call the first set of products that we go live with, complete, and then we'll move on to more specific use cases. But in that, I think the response to this new approach has been phenomenal. We've kind of got to around 7 lakh investors, people who are investing a cumulative of 8,200 crores in our funds in less than 2 years, making us the fastest growing fund house. I know there's a base effect, but fastest growing fund house over the last 2 financial years for us. But this is a new venture. That's where, say, if you see, we've launched, I think, around 6-7 ETFs. Those are branded as Case, and hence the Case platforms kind of starts coming into these individual brands. But if you see, all our ETFs are like Liquid Case, Top 100 Case, Gold Case, Mid 150 Case, etc. Those are the tickers that you can invest in them on the exchange itself. And the third part of our business is the enabler part, which kind of enables all of this. But Gunjan talked about the publisher platform. This is basically a SaaS solution, a software for any investment manager to create portfolios, which are their research or advice, helps them scale the business without having to focus on the operational aspects of it. So from client onboarding to execution, reporting, compliance, communications, fee collection, all of that the platform helps them with, so that our collective of 140 managers can focus on what they do best, which is communicating with investors, doing their research, managing their portfolios. Another platform that we use, again, is not a consumer-facing thing, but is called Gateway. With this, we kind of work with over 250 different distribution platforms, be it digital wealth platforms, banks, brokers, IFA networks, etc., so that our products can ultimately reach the end investor. So that's another part. These are the technology platforms we build, but both are again kind of coming through to enable the delivery of our products. So this is what kind of case platforms is today across model portfolios and our own index ETFs, and the technology to deliver them to the end customer by partnering with every single distributor out there. So today it's a lot more clearer what our business is. Think of us as a investment product player, or say a manufacturer of products, where on one hand we kind of get the product IP from 140 research analysts and advisors. They're all offered as small cases. On the passive side, where these are all index based, there's not so much IP. We create them ourselves in the fund format, and then to deliver them to the end investor, we provide technology so that 250 different platforms, some of the most respected institutions in the country, use so that these products can touch every single portfolio of their client base. But because of what we do, we don't have, say, competition today. It's kind of very rare. There are obviously many ventures that have tried to replicate what we've done, but just been fortunate that we've been able to survive, outlast them, and hence kind of create one category on the model portfolio side. Now we're on the path to create another category on the passive side as well. But because of that, we've been privileged to kind of partner with so many different businesses, all the top banks in the country, top brokers in the country, all the leading investment managers, asset managers, mutual fund distributors, advisors. We work with almost all of the largest and fastest growing brands that you would know about. And because of that, we get an aggregated view of what is happening in the industry. Then that's what I want to talk about next. There are a few trends that we are seeing that are shaping the industry. These might kind of continue for the next 5 to 10 years. These might very quickly happen in the next 1 2 years. That's, I think, depending on how investors receive them, how the entire industry kind of adopts some of these trends. But I think from either a investor perspective, from say industry perspective, or from a regulator perspective, I think like I've compiled 5 trends, but I think these are things that are going to kind of happen over the next 5 to 10 years. They're going to be irreversible, and because of which there will be uh, impacts on the entire industry landscape. So I'll just move to the first one. Most of these will seem obvious, but I think today we sit in this era where kind of it's easy to say that yes, financialization of savings would happen, but when we started Smallcase in 2015-16, there was no evidence to that. The whole promise of people investing into equities, mutual funds, or any financial asset for that matter was still a promise, as in it kept looking like that time would come, but it never really fructified like how it did in the last 5 years. But I think this is an irreversible trend, as in this happened somewhere between 2019, 2020, where for the first time, individuals and households allocation shifted from physical assets to financial assets. And that trend has continued moving towards the skew of financial assets. And when I mean financial assets, it's not just equities. You have fixed income, you have other asset classes, but them essentially being in a financial asset format versus say a real estate or gold or say a commodity that you're holding in a physical format, I think that trend is irreversible now for a variety of reasons, be it how digitization has happened, how say investor literacy has increased, education has become, we are obviously the youngest country today, the youngest it's ever been, which means longer investment horizons, higher risk tolerances. So combination of all of that is getting us to this path where for the foreseeable future, financialization of savings will be a trend. This will have multiple second order, third order impacts. For example, say even for certain physical assets like real estate, I think there's this whole movement that's going to start happening. Maybe you won't see it immediately right now, but given everything is getting digitized there, I think tokenization of real world assets will happen much faster than we think it would be possible. And then you can then trade them like you do a stock or, say an ETF. So while those things happen, the other second order, third order impacts would be how people borrow in this country. For the longest time, obviously, people either don't have a credit history and hence go for unsecured loans. On the secured side, large books have been created on the back of gold and property. So loans against property, loans against gold loans have been very huge books that many players have already created. But as this pattern also starts shifting towards financial assets, there will be new categories of credit, new ways that people will start borrowing, which would be cheaper because these financial assets are digital, easy to pledge, easy to unpledge, easy to redeem, more liquid. So I think the whole secured credit will start moving from some of these more traditional assets to financial assets as well, but multiple second order, third order impact. But I don't think this is a reversible trend. We'll continue seeing more and more of this. The second one is a little more technical, but I'll try to explain it as simply as I can. But today, if you see how India's investments are, if you look at all individual investors, how they're individual and institutions, how they're investing into different products in India, it's across two styles. When I mean styles, it's not how the investor is investing, but how these products are managed. They could be actively managed, where you have a fund manager who's taking an active call on how to create that portfolio, manage that portfolio, like say many of our partners do today. Passive is where you're just following an index. Now that index could be very specific, it could be very generic, it could be broad-based, but it's an index. There's no manual override of that index. And those are called passively managed investments. So 5 years back, or let's take say 10 years back, this number was, or this percentage of what the average investor's portfolio used to look like was around 99.1, where say 99% was in actively managed products because they're looking for alpha, they're looking for outperformance, and hence they would give it to a fund manager who is kind of creating that alpha over the index. 1% wasn't passive. 5 years back, if you look at that number, it's 95.5, where say 95% is in actively managed investments, 5% is in passive. Today, if you look at that number, it's 85.15, 83.17, 83% is in active, 17% is in passive. And this is a phenomenon, again, that has happened globally in every single market where it goes to 50-50. Now, what does that mean? Like half the investor's portfolio is looking for alpha, half the investor's portfolio is looking for index returns or beta. And like people say in India, it's tough for it to happen. There are many reasons why it won't happen so fast, etc. But I think for multiple reasons, we are at that inflection point where this will start moving to 50 very quickly. I think by the end, in the next 5 years, we'll be at more like 70-30 and eventually 50-50. But what this means is, it's not that alpha is not there in the market. 50% is still chasing alpha, which means there is alpha. There will be alpha, but it won't be in the same areas or the same form factors in which today it is. Like for example, today I think there is some easing of how mutual funds can be managed, but mutual funds have become more and more restrictive over time in terms of how a fund manager can manage it, which is where, say, some of this alpha behavior has come to more flexible portfolio formats like a PMS, AIF, model portfolios, etc. But mutual funds are great vehicles for index now versus, say, an actively managed strategies. Similarly, I think on uh, new assets or new types of exposures itself, like SME didn't exist, say, maybe 10 years back for us. Say, today, even it's tough for people to invest abroad. I think in the next 6 to 12 months, you'll see this being eased out, not just from India, where you can invest into a feeder fund, but through LRS, through the GIFT City route. I think there'll be more such options, but there will be many more newer asset classes that will get unlocked. And hence, many of those will be where, say, there would be lesser data, there would be more information asymmetry, and hence there will be potential for alpha. But many of the more discovered asset classes that most of us are investing in today will start moving towards beta returns, where you can get, say, a 10-15 basis point exposure to that asset class, and more of your portfolio will move towards that. I think this is another trend that we are playing on. We don't think it's a binary trend where it will go to 100-0 eventually, but it will go to 50-50 and keep moving within that range, 45, 55, 55, 45, depending on the market cycles. The third one is important because I think it has an impact on how all of us also look at investing. Many of us in the wealth management industry also think about things, but I think every app will offer financial products. And this is more true for a country like India, and we haven't seen this play out in other markets, but we are seeing this rapidly increasing. We are seeing this on our technology platform side, where today demand is not just from the traditional or the wealth first companies. Now we are talking to companies, apps, ecosystems who have nothing to do with, say, investments as a core business, but they want to offer an investment product because it solves a use case. So you'll see this again everywhere today. I don't know how many of you know Flipkart is one of the largest digital loan distributors in the country. Say, today if you look at all your top payments apps, it's actually people who were not doing payments or financial services earlier. WhatsApp is now doing micro insurance, micro pension products, etc. So I think this as a trend will stay. What this means for how people will invest is also that because many of these are tech first platforms that don't really want to take in the burden of advisory or say which product somebody should invest into, they'll just default to selecting passive products or index products where it's simpler, it's transparent, it's easier for someone to basically say I'm investing into Nifty 50 or Nifty 500 or gold, whereas an active product will have saying that in large caps I'm going to try and give you the best returns, which is tougher to explain on a digital medium. So this will have an impact on how people start allocating to investments as well, which is where say more than lower cost, I think more simpler, transparent options will start taking many of the shares. Like even in the previous one, active to passive, I don't think active will degrow. I don't think it means that money will move from active products or funds to passive products. It's just that passive will grow much, much, much faster than active, because of which the ratios will kind of come to 50-50. So for example, even if we say that in the next 5 years, that ratio will become 30-70, 30 in passives, that means a 6x growth from where we are today, whereas the entire industry will probably grow by 2x. Passives will grow by 6x because there are two underlying levers playing out there. The fourth one, I think this is something that everybody gets worried about in different parts, but like today, the number of AMCs, number of people starting up their own PMSs, AIFs, their own model portfolios, etc., is just growing. That means there will be more managers, there will be more products for the end investor to choose from. It's also an opportunity. I think if you look at it from an opportunity perspective, that's where, say, the scope of advisory, the scope of helping you make a decision also comes in. With, for example, AI coming into many of these flows, things could get better, things could get more confusing, but this is a trend I don't think again will reverse. There will be more products, there will be more managers, and like even today as a country, India, we see the number of asset AMCs in India itself has grown from I think 43 years back to now around 55. That's like it's kind of grown by close to 50% itself, and there are more people who are applying for it. But today, for a size of India's AUM or assets in mutual funds, we are still very underserved because there are only 50 AMCs. Typically, if you look at any other country, there should have been maybe 150 to 200 AMCs. So this is not a bad trend. This will continue. Market depth is also increasing. Obviously, all of you know the number of companies that are listed. Even if they're not listed, you can access them now. So the market depth generally in terms of what you can invest in is increasing, which will have interesting opportunities on both the active and passive side. So I think this kind of makes it more important for how we as investors kind of shape our portfolios as well. And I think that's maybe the last trend which kind of clues into this. I think the investor's role will become more of an allocator versus a picker. Like today, you are constrained by the number of assets or opportunities or options or products that you have. As in, it's grown over the last 5 years, but it will only spiral or multiply over the next 5 years, not in just terms of how many companies are listed or how many unlisted companies are interesting, but also in terms of what assets you can invest into. So if you see, I think this will be a big wave in how manufacturers or asset managers, PMSs, AIFs, research analysts also offer solutions. There are more number of, say, because Today, if you see what AMCs are launching, and many of the CIOs who are launching their own AMCs are choosing to do it in their flexi-cap fund. Why are they choosing the flexi-cap? Because they have flexibility on how they can invest between large caps, small caps, mid caps. So it's kind of a solution versus a product. A product is something like a large cap fund, which is investing into the top 100 stocks, but with a flexi cap fund, it's more of a solution than a product. Similarly, with fund of funds, with model portfolios, the uh, kind of ways that you can actually solve a use case will only increase, which is where an investor will start taking these calls as to which assets they want exposure to or which opportunities they want to invest in versus basically saying, is this stock better than the other stock? They'll say, should I invest into micro cap 75 versus small cap 150 or small cap 250 versus mid cap 150? Like those are the questions that will start coming in. So you'll see a lot of AMCs, PMSs use their funds or use model portfolios as use cases for solutions so that someone can actually come in and invest their money into a specific use case versus just basically saying we create products. I think that shift is only starting to happen. But yeah, these were like I could compile it into 5 trends, but these were the key 5 trends that I think will shape asset and wealth management industry in the next 5 to 10 years, and that's what we as case platforms are actually playing on. Thank you.
So, wanted to know how this idea clicked to you, how you started this business at from non-engineering background, non-market background, and how did this idea come to you, and how the three of you work together.
We are actually from an engineering and markets background. But so I'll introduce my two co-founders, Anugrah and Rohan. We know each other from college. We studied together at Kharagpur. Anugrah and I did our masters in economics there. So we studied economics, finance, how say many of these products work for 5 years. Did our masters there, and Rohan did his masters in computer science. So after graduation, we went our separate ways, but we were in the financial services space itself. So Rohan went to Goldman Sachs. He was building trading platforms for the US markets. Anugrah went to Nomura. He was in the front office in Bombay. He used to design many of these indices, thematic portfolios for institutions across Southeast Asia. I went to this startup called Traction, where now it's like a leading database for private companies. I was the first employee there, so learned a lot about how, say, a new asset class kind of, what are the ecosystem you require to kind of build that asset class. But the reason we started was, I think this was 2014, 2015. We were 23, 24-year-olds. I come from a capital markets family, like the family has really been into capital markets itself, but still we were not investing as much as we should. And I think that was the problem that we wanted to solve, that why are people in our network, our peers, not investing like, say, people that we knew who are avid investors investing. So we felt it's not really just, say, having a great UI UX for a brokerage or a investing platform, or say, the cost for it, but there were players who were doing that, like Zerodha was doing that at that point in time. I think Growth started in 2015, 2016, but what we felt we could really do a different job in was actually the product layer. Like it was either stocks or mutual funds at that point. Can you have portfolios of stock? Can you have ETFs? Can you have portfolios of mutual funds as new ways for people to invest, which makes it easier for them? So that's the journey we started. And today we still do the same things in the sense Anugrah looks at product like he used to do at Nomura. Rohan looks at tech engineering like he used to do at Goldman. Everything else is on, so that's why you'll see more of me, but basically those two do the work on a team.
So Zerodha operate in the same industry, and everyone thinks like, why did they choose to partner with Smallcase for Zerodha Fund House when like they don't have any capital constraint, they have brand, they have distribution and everything. So why they chose to partner with us, and what is the role of Smallcase in Zerodha Fund House?
No, sure, Vikram. So this, like I told, it goes back to 2018-19. So 2018 is when we added ETFs to the small case format. So before that, it was just stocks. Then we felt ETFs. Now liquidity is growing, more people are participating. So can you create a multi-asset portfolio with ETFs? So we added that in mid to late 2018, and that's where we saw a lot of success in how people were adopting ETFs. They liked it because it was real time. It sat in their demat accounts. They could get in, get out of it whenever they wanted to. They could capture, say, real-time market moves as well, right? So, but Where we were getting stagnated was also just the number of ETFs that were available. And we work with the industry, we work with all the top asset managers, but we felt that for this to basically become a large catalog or menu, you need to basically have the business model that supports it, which is to be a passive first asset management house. So that's where we started thinking about it. I think parallelly, Nitin, who was our first partner, also expressed the same thing, saying that we've been thinking that maybe the time is ripe for like a Vanguard or an index kind of approach to start in India, because it will unfold over the next 10 years. And this is the time where still passes where 1%, 1 to 2%. So today it's come to 17%, which means the movement has started, but both of us felt the same things. We obviously at that point in time had a great working relationship for 4 5 years. Uh, if you look at how Zerodha generally operates, they basically say we stick to our core, which is growth. Everything else we partner with different entrepreneurs, teams who want to do the same thing. And second, we had experience on the technology side because we were working with so many entities. We had experience on the investment product side. So we felt it was a marriage made in heaven where both of us could come together. They could help us with the distribution, the brand, the ops. They have a very savvy vocal user base, which is important for say a new product class like this to kind of get kick-started. We came with the creation of investment products, the manufacturing, the technology, all of that aspects to it. And if you see, most of AMCs are also in India joint venture between a manufacturer and distributor. In this case, both are tech entities, so the lines get blurred, but that's where we felt together we could do much more than what we could do.
Many people think Vasant Kamath is relative of Kamath brother.
No. I'm sure here, like my colleague Rakesh says, that's what. It's surprising why I get this question, because I'm sure in this room there are so many Kotharis, so many Shahs, Mehtas, but none of them get the questions. But it's just a happy coincidence we are not related.
So close that I can whisper my question to you, but but it's a very interesting juncture in small cases. Life cycle, because I think that you have two great opportunities in front of you. One, like a digital distributor for, or becoming like the Amazon of the financial products in the country. And the second is to basically eye for a Vanguard kind of a ETF provider in the country. And both of them would require extreme focus, deployment of resources, your mind share, everything. And it's very confusing because in both of these arenas, there are not very innovative players, in fact, in the country right now. And it will be a dilemma for you also to, speed up what at what time. But how do you think about both of these trends as an opportunity? Because the scale at the ETF business can be really, really large. And that can really catapult, the company to a space which, it's an uncharted territory right now, but no one knows what the future is, but it's a really large opportunity. And the other is an opportunity where there has been a lot of regulatory overhang and things have kind of settled and then unsettled, and again a lot of things. It requires a lot of energy to build that, but once you've built a platform like that, the cross-selling that you get, the kind of power that you get to interact with the consumer is immense. So how do you think in the sense between both the businesses is what I want to know.
No, great question, because I think for us also it's taken some time to get to this where you can actually reflect back and say, how are you thinking about this, right? So, and because it's not so much because the journeys are different, as in the journeys are similar, be it, like I said, small cases or be it ETFs, they are both investment products. We are building it for the same user who's a retail investor. Now the question is, how do you make the products relevant? How do you get it to them most efficiently? So if you abstract to that level, it's basically the same journey. As in, can I launch an interesting ETF that's not there? Now, how do people discover it? Can I build integrations with players so that this comes up on the radar of the investors? It's the same thing for a small case as well. For example, say when green energy was not there, thankfully you came in to create it. But today, if say there is a theme that investors are looking for, I have to go out, look for someone to come and create it. So how do I ensure we have relevant products? How do I ensure we can deliver it to the end customer? These are the two problems on both ends. Obviously, the Other things is where energy actually goes in, which is something that I think will reduce over time. But how how do you offer these products? Like in an integration, can APIs be used according to the new regulation or not? Those are the things where time goes more versus these two aspects. But now I think we're at this stage, both on the small cases and ETF side, where regulation for us is pretty clear in terms of no, like there's no known negatives. Now unknowns might come in, but now we know that there's no known negatives that are going to come in. Anything that will come in, most likely than not, will be positive. For example, say fractional shares we talked about. For example, say RBI now is starting to ease many things, but maybe soon they can start increasing the limit of global funds as well. So all these will be opportunities for us. But ultimately, that's what the way we think about it is, both are effectively the same thing, as in you are creating relevant products for the end customer. If we expand to US equities, is it relevant for the end customer? Then how do you get it to the end customer? So that's where most of the mindshare should go, and now it's starting to go over the last at least say 2-3 months. But for this period in between, where be it figuring out integrations, be it figuring out regulations, be it figuring out how do you get the first set of products onto your platform, like on the AMC side, 2020 is when we started this journey. Like what you're seeing is the last 2 years, but from 2020 to 2023, setting up an AMC is not trivial. Right from, say the infrastructure for it, the vendor. Now we know that, say, if we are planning for a scale, which is say maybe 25x where we are today, you have to internalize a lot of the tech. So we're saying we'll do it in steps, but we'll start on that journey because we know that, or we want it to happen at some point in time. So those are things that we have learned from the small case journey, saying that at some point you'll have to work on stabilizing the platform, making it a stable foundation, a versatile one. So the same thing is kind of applying on the AMC as well. Things that we're learning on the AMC, we're applying it to small case, because now small case is now also a regulated product class. So those parallels work very well, but ultimately when you abstract it, it's these two things that we have to keep spending our time and energy on.
So I have a hypothetical question, but let's say 5 years from now, we have a AUM of 5 lakh crores or something in the ETF side, and similarly digital distributor of such an AUM. What is the yield you think on those assets you would be making? Maybe a hypothetical number, you can take a lakh crore or 5 lakh crore, whatever, or you can give answer for both. Is the yield that you'll be able to take out in both these businesses is going forward what you have in your mind?
Next 5 years, I think on the AMC business, because we're doing only passives, we would be making net, I think, between 10 to 15 basis points. Today we make around 20 basis points, but as you have more scale, more products, that will reduce. But then that's always been a scale game. On the small cases side, I think will be around 2x of that on a net basis, because these are, like I said, active products, and hence people are looking for alpha, and hence okay to pay more with that risk as well. And hence our derivative, the value that we derive will be higher as well over there. So from a cash generation perspective, small cases will be where kind of a lot of cash is generated from an eventual scale business, as in where will AUMs be a lot more? It will be the AMC ETF business itself.
One last question on liquid case. So this product has become like instant success. So how it is different from other liquid based ETF?
No, sure. Like this was the problem that we faced in our small cases as well. Like instead of a cash replacement, people used to use a liquid ETF. Now liquid ETFs, they were only the dividend versions, which meant that, say, like liquid beef, for example, is 1,000 rupees. You buy it for 1,000 rupees. You keep getting dividends as returns. That 1,000 rupees face value doesn't change. So two things happen. One, when you sell it, that 1,000 you get back for the units, but the fractional units stay in your demat till they become one full unit. Only then you can sell it. You can go to the AMC and fight for it, saying that, yeah, I have 0.1 of unit of liquid bees. Can you give me 100 rupees? But most people don't do it for 100 rupees. When it becomes 1,000, that time they can sell it from their demat itself. The other thing is, because they're getting dividends every week, they get taxed every week as well, as in tax applies every week. So that's what we wanted to change, because otherwise, like, all from feedback from managers and small cases was also that this is not a good replacement for cash. So when we could launch our first ETF, that was our first ETF liquid case, where we launched the first growth version. So it started at 100, today I think it's at 108, 109. But that value keeps growing. What that means is, and we priced it also less, so that one, you're taxed only when you redeem, not every week, like in the case of liquid fees. Second, there's never a problem with redemption. You can redeem exactly how much ever you have invested, and the returns on top. That is an example of, say, product differentiation for us at the. I don't know how many other product differentiations we can prove, but whatever we can pick up, we will definitely pick up and build that up. And that required technology, that required solution, which is where we should launch it first. Now, I will be at.
Thank you so much. We have received some questions from the audience. Can we have that on the screen?
I don't have a timeline, but I want, like, I think we discussed this also that time, but two to three things need to happen before we do that. One is get the AMC into a steady state. Today it's too young a business for it to be get in terms of margins, how that. Second is small case today is equity only. That's where we're adding mutual funds, fixed income, global equity, so that some of the Indian equity cycle linked volatility can go away from that business. It won't fully go away, it will largely be an equity linked business, but some of that can go away. And third is, hopefully in the next few years, we'll start making some non-rupee revenue from other markets as well. So some geography diversification as well. So all planned for the next 2-3 years, but till some of them kind of unfold, I can't give a timeline.
Vasant sir, can I ask a question from here? Yeah, I'm on your right side. Here, raise my hand. Yes, sir, I am an active user of Smallcase since almost 2021. One problem which is still there in last 4 years, when the amount of investment goes high, uh, you, I mean, when I press the rebalance button, it buys share at any price. Actually, it is echoing. Anyways, so, and secondly, if I buy or sell something in broker platform, it is not synchronized in Smallcase. So these simple things are not fixed. So I wanted your thoughts on that.
No, thank you for that. Thank you for using small case in investing. But these are two things that are, from a wish list perspective, we want to solve for, but is difficult just because of the infrastructure that supports it. Like, I can give you more detailed answers and discuss with you as to why this doesn't happen, but we're now getting to solve it. One is basically why this doesn't happen. I'll just answer your second part first. Uh, what happens on the broker side, we don't have access to, and that's how it's supposed to be, because on the broker might have other platforms where trades are going on. We should not have access to it as Smallcase, and that's how the broker wants to define that. What can you do for that? One way is to prevent small case stock orders going through from the broker itself. That might be limiting, but that's the most foolproof way of doing it, and that's what we are achieving at every broker one by one, so that you can't go and place this order itself. That will limit your first use case, where, for example, you want to place a limit order, I'm guessing, on that.
Exactly.
The issue with limit orders is you can't put it as an aftermarket order today, at least in most of the brokers' constructs that we have access to. So you can do it maybe on the broker's thing directly, but that stays for that day only, it doesn't get passed on to the next day. So we're trying to come up with something for that where, instead of you placing the order prematurely, we basically, you can come and place it on that day in a limit that, say, the manager itself is asking you to place it at, so that then, that also goes away. But it's something that we would ideally like to do across all brokers eventually, which is why we're talking to each broker to see how we can do this in the same consistent manner, versus one broker having it, other brokers not having it, or it's a different implementation on every single broker. But we'll do that soon, as in, we know that that's a problem area that creates issues on the rebalance day, etc., but we'll do that.
Thank you.
Thank you. Thank you to all our speakers for such an insightful and engaging session. May I now request Mr. Ashish Amin to kindly come forward and present the memento as a token of appreciation to our panelists.